We are seeing broad pressure, I should say, on the markets. The TSX is underperforming. We're putting in our worst single-day showing since February, but it's not much better in the U.S. On a percentage basis, it might be, but pretty a wholesale washout day. There's a look at the Dow being held back, definitely by United Health, but pretty much everything is down except for tech stocks. Tech is one area of the market that our next guest recommends investors take a look at, as long as it's at a reasonable valuation. Art Hogan, Chief Market Strategist at B. Riley Wealth Management, joins us now. Art, is it getting harder to find these reasonably valued tech companies?
Well, I would tell you no. I think that last year was all about the Mag 7. This year, there's only 5 of those companies that are actually in positive territory, obviously led by NVIDIA. And NVIDIA just put on a spectacular report last week and continues to have a lot of runway in front of it. But I think one of the underperformers this year clearly stands out to us when we think about Apple. It's on our focus list. They've got some exciting news. They reported a strong quarter. They upped their buyback, and they've got some interesting news coming out in the month of June at their Worldwide Developers Congress. And I think that will put them clearly into the game of artificial intelligence. They're an early adopter. They don't usually come out first to tell you how it's going to be put into their products, but their next iPhone likely rolls out with some very exciting features, and they'll likely let us know who their partners are in this endeavor. So I think Apple of the group looks like it's the cheapest unto itself on a multiple basis, throws off a dividend, and certainly has got some catalysts in front of it, both in the month of June and certainly when they roll out the new product in the fall.
You know, aside from some of those, stock specifics, generally we're seeing a pretty big washout day. Some investors are putting this at the feet of, a bad treasury auction, suggesting, yields are going to go higher at a time that the Fed is not keen to cut rates. How are you thinking about this interest rate boogeyman, and does it deter you? And you still see some upside, a little bit left in the tank for the S&P 500.
Yeah, we do. I think that we go through these phases of the Treasury curve getting a bit of a backup in yields. We saw that in the month of April, where we got to 4 3/4 on the 10-year yield. We're above 4.5 now, which is a trigger for a lot of folks in terms of expressing a risk-off opinion. But the interesting part about that is last October we got up to 5%. So we continue to make lower highs, and I think that's important. I think the trend in the yield curve likely is lower throughout the course of the year. That may not come with a September rate cut, which is certainly looking like less than a coin flip right now, but I think the language around the Fed likely changes a bit after we get this week's PCE report, and that comes on Friday. It's the favored inflation gauge for the Federal Reserve, and we suspect it's likely going to move down on a year-over-year basis at the core from 2.8 to 2.7%. Directionally, that's not something we've seen yet this year, so I think that's going to be a big help. I think that'll shift the narrative around all the Fed speak to something more along the lines of that we'd likely have the comfort to cut rates come the fall, and September is still our target for that.
Inflation, though, and you know this, for the past couple of months has been surprising to the upside. What if the surprise on Friday is again to the upside? Our market's vulnerable here.
Yeah, the good news on that front is 2 months ago, we certainly surprised to the upside on both CPI or on CPI. PPI was very much in line, maybe even a tick lighter. The latest reports on both CPI and PPI have actually come in better than had been anticipated. So it feels as though we've gotten through that storm a little bit. The interesting thing about the personal consumption expenditure component, the PCE, is that we know most of the details about that before it comes out. A lot of the inputs come from the PPI. So we likely are going to have an inline, if not better, PCE, and I think that trend will continue through the summer and into the early fall. So I think a rate cut this year is still on the table. I certainly don't think any rate hikes are in the offing, and I think that the narrative just needs to change back a bit, and I think that'll calm down what we've been seeing in the yield curve and the Treasury side. You've always come on and advocated a barbell approach, so tech on one hand, other pro-cyclical areas like energy and financials on the other hand. Is the market looking a little bit too defensive for your comfort? I'm talking about the rally that we've seen in staples, in utilities, still tech. So tech is working, but typically when you start to see some of those more defensive sectors outperforming, does it not tell you about a little bit of caution taking hold in the markets? Sure, yeah. So I would argue that you're correct on the staples front. I think the utility bid has really come from a different place this go around. So I think it's the realization of how much energy we're going to need for all this disruptive artificial intelligence and the power that we need and the massive compute power, et cetera. So I think that's become a bit of a AI adjacent trade more than a defensive trade on the utility side. It's certainly is true of, I would say, of the staples of late. But I certainly think if you look at what's going on in other sectors that are less defensive and more pro-cyclical, you're starting to see the participation and sponsorship pick up. So I would say energy has certainly got more tailwinds than headwinds right now. I certainly think profitability of energy companies has been as high as it's been, and their multiples are the least demanding of all 11 of the S&P 500 sectors, ex the REITs. So I still think it's the right place to be. But you're right. It's interesting. It's quite a quagmire to be thinking that utilities and staples can be doing well in what could be a more robust economy, which has certainly been proven out so far in the first quarter and so far in the second quarter, and certainly powerful earnings growth, with the S&P 500 reporting about 6% growth when it was anticipated to have about 3.4%.